Inheritance tax is a voluntary tax, and we're looking at some of the things that you can do with inheritance tax planning. It's now come to where we want to start reducing the tax. So the first thing that you need to do is make sure that you are using all of the relevant reliefs. Everyone's got a nil rate band of £325,000. That means that on your death, £325,000 is subject to zero tax. And if you choose to leave your home to your children, then there could be a further £175,000 available as a nil rate. That means that in the right circumstances, you could leave £500,000 to your beneficiaries without there being a tax consequence. You've also got an annual gift allowance of £3,000. That can be spread between as many people as you like, but it is only £3,000. You have a small gift allowance of £250, which can be used again as often as you like, which means that you can gift it to lots of people, but none of those who have received any of the £3,000. If you have more income than you need during your retirement, then you can make larger gifts, providing they come from income and are made on a regular basis. But there are two important things here. One is they must be from income. You can't borrow from your capital to gift. They must not impact on your standard of living. You can't take money back from your capital to replace the income you've gifted. And they must be regular. So if you do fall into this category, please make sure that you keep records so that when you die, your children or executors have a record to confirm that these are exempt gifts. You can make much larger gifts, of course, providing you're comfortable that you aren't going to run out of money. And you can use trusts. Now, making a deposit or an investment into trust is classified as a gift. If you make that gift and it's less than the nil rate band, then there won't be any tax payable at outset. And if you survive 7 years, then that gift will fall out of your estate for inheritance tax purposes. However, as I said earlier, if you make a gift and retain any benefit from it, then it won't count when they do your inheritance tax calculations. So although trusts take your assets outside of your estate after 7 years, you need to be certain that you don't need those funds, but they will be ring-fenced for your beneficiaries. But there are 2 exceptions to this, both of which will let you have access to some of those funds. And if you'd like further information on either of these, then it's important that you have independent financial advice. And I would be delighted to talk to you about these things to see if they are right for you. And I'd welcome a call to set up an initial meeting so that we could explore it further. I look forward to hearing from you.